Welcome to the Discount Property Investor Podcast, where we show you how to buy real estate at a discount so you can create wealth over time and income today. Our mission is to share what we have learned from the experience of others and help you make more money investing like a pro. We want to teach you how to create wealth by investing in real estate, the Discount Property Investor way. Thanks for tuning in.
All right, guys, welcome back to the Discount Property Investors. This is your host, David Dodge, co-host Mike Slane. Hey, Mike.
Hey, guys. Welcome to the show.
How you doing this morning, Mike?
I'm good. I got my morning cup of coffee in, so I'm ready to go.
Ready to go.
Yeah, let's
awesome,
do this.
Man. Let's do it. Today, we're going to be talking about exit strategies for wholesaling real estate. So there's actually quite a few different ways that you can exit a wholesale deal and get paid. Most importantly, would be getting paid.
Yeah, absolutely. It's funny. You say there's many ways to exit a wholesale deal, and I totally agree with you 100%. Mm-hmm. But when I look online sometimes, or I listen to new students come up and ask me about, oh, well, if you assign the deal, it's not a wholesale, versus if you double close, then it's a wholesale, or vice versa. And I just, honestly, I kind of think, who cares?
Right.
Either way,
I agree.
You're buying and selling the property, or you're buying and assigning the property.
I agree.
And you're making money on it.
You're making money. Who cares?
You're not spending a whole lot of money on it, so you're making money.
If you're buying it off market and you find a buyer, who cares how you find that buyer? Who cares how that buyer buys? You're getting paid.
Right. As long as you're doing everything within the confines of the law, you're not cheating people, obviously. Right. You're not being fraudulent.
Oh, no. We would never
exactly.
do that.
So let's talk about what a double close is. So a double close is my preferred method of closing. I think we do it probably on most of our wholesale deals. Mm-hmm. So what happens is we go out, we market for the property, we get it under contract. In this example, let's say we get a property under contract for $100,000. Okay. Dave here is going to be the A seller.
Okay. So I'm Mr. Seller.
I'm going to be Mr. Wholesaler in this situation, so I'll be B. So A to B contract I've got for $100,000 with Dave.
So I sell my property to Mike. He essentially writes me a contract for the property.
That's right. So contract, A to B contract, right there. Okay, so then
you, audience,
can be the C buyer.
C buyer.
All right, so I, Mike, as the wholesaler, said, hey, audience, I've got this great deal. This property is worth $200,000. It needs a little bit in repairs. It needs $30,000 in repairs. I can sell it to you for $120,000. And you say, well, wow, that's a great deal.
That's a great deal. So you're gonna pay Mike $120.
So what I do,
to put $30 into it, but it's gonna be worth $200. So you'll have a $50,000 equity capture if you buy that deal for $120.
So you say, let's do it.
That's great.
We lock up the contract. I send you a contract. You sign a contract for $120,000, and you decide you're going to close, let's just use next Friday. So then I say, hey, Dave, can we close next Friday?
And I say, hell yeah, man.
So my AB contract, we may need to amend it, and we say we're going to close next Friday. We have a contract with our audience here, or I have the contract with our audience here, close next Friday. I bring them both to my title company. Hopefully I've done this a little bit earlier than the coming next Friday. They're going to need a little bit of time to do the due diligence that title companies need to do. They sort the details out, and everyone goes next Friday, signs their closing documents. I'm going to sign 2 sets because I'm buying it from Dave, and then I'm selling it to you, audience. So I'm signing 2 sets of closing documents. Dave's going in there, and he's selling his property. He's signing 1 set. You as the audience are going in and signing 1 set of closing documents. You're bringing $120,000. The price that we agreed to was a great deal on the house. I'm bringing $0, but I'm signing 2 sets of closing documents.
I'm going to highlight that. Mike was bringing $0 in.
That's right. Dave is walking away with his $100,000, so he's happy. He was able to get rid of his property that needed a lot of work.
True win-win-win.
Right. And then I'm walking away with $20,000 as the wholesaler.
Right. And me, Mr. Seller, I'm motivated. Let's say I'm going through a divorce, or I inherited the house and I don't care about it. I don't really care that Mike's purchasing it and reselling it. Now, the benefits of a double close are that nobody in the transaction other than Mike being in the middle knows all the figures. So me as Mr. Seller, I don't know that Mike's turning around and selling it same day or even later. Well, in this scenario, double close would be same day, and making the $20K. I don't know that, but even if I did, I really wouldn't care.
Correct. So let's talk about this same situation.
And just real quick though, the audience that's buying it for $120, they also don't know that I'm selling it to Mike for $100. So again, that's the benefit of a double close. Is the title company
let's talk about the assignment. And
protects the fact that you're buying it and you're selling it, and those Essentially, it's two different transactions. So,
Absolutely.
assignments. Let's talk about assignments.
Let's talk about the assignment. So similar situation. I'll be the B. Dave's going to be the A. Audience, you'll be the C again. And we're going to keep the same figures just for the sake of simplicity.
Right.
All right. So I negotiate with Dave. I say, hey, Dave, I'm going to buy that house for $100,000. We've agreed to it. I've got the contract with Dave. So I have my A to B contract, and I'm purchasing it from Dave. Dave says that is great. I'm still looking to close next Friday.
And this is a great example too, because you could go to this is an example where an assignment would really make sense.
Yeah, let's talk through it.
Right.
Yeah. So then I go to you, audience, and I say, I've got this contract, this property for a certain price. I'd like to sell you this contract for $120,000, and you'll basically be buying the house for $120,000. You say, well, wow, that's a great deal on a house. Okay, let's go ahead and do it.
Yeah, I want to make $50K in equity.
So here's how we do assignments. At least here's how I like to do an assignment.
Right.
I would go to the seller and I would say, let's sign this purchase and sale agreement first. So I'm going to sign that contract.
Yeah.
Then I've got you locked in to purchase the property next Friday, just like before.
It's a great way to do it.
But then instead of doing the double close, like we said, I'm going to bring you an assignment contract, and I'm going to send you my original AB contract with Dave with the assignment.
Right.
That at that point you can see you are basically taking over that contract. I'm assigning all of my interest, the B,
but also the audience
to
in this scenario, C buyer audience, they're already locked in to purchase this property.
Correct. So that's why we do that. We like to, again, because with new buyers in particular,
right,
we're going to do that because we don't want them balking at the $20,000 assignment fee. Because again, audience, you come in and you say, well, wow, I'm not going to pay you $20,000 just for this property. That's not fair.
Yeah, that's
what
not
did you
fair.
do?
What did you do?
Again, that you've already agreed to buy it at 120, so we say, okay.
But really, what did we do? We did a lot. We spent a ton of money on marketing. We took 100 phone calls to get to that one.
As you audience are well aware, if you're doing some wholesaling or trying to do wholesaling, it's a lot of work.
It's a lot of work. Yeah, exactly. So we went on tons of appointments to get to that deal. We found that deal. We negotiated with that deal. And maybe we weren't able to lock it up day one. Maybe we had to call that individual back and follow up with them for 8 months. So it's like, yeah, we did a lot of work actually, and we earned that $20K.
So in our market, at least in my mind anyways, too, when do you do a double close versus an assignment? And Dave was talking about this a little bit earlier too. So my threshold is always $5,000. I think if someone's going to balk at paying you $5,000, that I just don't see that happening.
Right.
If you're making over $5,000, I would think you want to do probably a double close just to protect your interest in it.
Yeah, but other markets and other people and other sellers, other buyers may have different. They may have a different threshold on that.
Yeah,
but
just a rule of thumb.
Rule of thumb. But in this scenario, though, which is a great scenario, if I bring a property to somebody at 120, regardless if I'm paying 100 or whatever for it, and it needs 30 grand, but they are then going to have a property worth 200,000. 9 times out of 10, they're not going to care that you're making 20 grand. They're happy to get that property at 120, because if they then want to refinance that property out and get a 70 or 75% loan, they're into that property for little to no money. That is a killer deal. So
yeah, we described a really good deal.
We did. So in this scenario, a $20K assignment isn't crazy. It's not unheard of. However, like Mike said, typically if our profit margin is between 5 and 10 or more than that, we will opt more for doing the double close. But assignments are a great way to exit. And here's the beauty of an assignment that I don't think that we do.
We didn't even talk about it yet. Yeah, go for it.
We didn't even talk about it yet. But when you assign a contract, you are essentially telling C buyer audience, in this case, you listeners and viewers, by you signing this assignment, you are taking over my responsibility as buyer. So I'm essentially still in the middle of this deal, but I'm actually going to step aside. I'm going to get out of your way. And you are going to show up to the title company like you would originally with a double close, but I'm not. And you're going to buy the property directly from the seller, and the title company is going to collect all the money, pay the seller the 100, and they're going to write me a check for 20. So I'm not going to have any expenses, I'm not going to have any out-of-pocket costs, and I'm not going to have to pay the closing costs, which kind of goes back to your expenses.
So those are the pros.
Those are the pros.
Definite pros.
Right.
Now here are the cons.
Let's hear the cons
this time.
Okay.
So one, you're stepping out of that contract, so you are actually relying on the C buyer to perform. So they can actually kind of mess up your reputation if they don't perform.
If they don't perform.
Again, it should be a good deal, shouldn't be an issue.
Right.
The other cons, everyone knows what's happening. The A buyer, they may not know about it, but they'll figure it out when they get to closing, and they see that you're no longer the person on the HUD statement, that it's someone else's name or a different company. They can put two and two together.
Right.
So again, it becomes very...
Usually they don't see that until the day of closing
exactly.
or the day before. But again, if you're working with a motivated seller, they don't care. Their main motivation is to sell the property and get some money for it. And if Mike shows up as, Household Easy Properties as the buyer, or David shows up with, with another company called Available Home Buyers or whatever example, and purchases this property, if the seller is truly motivated, which is what we're teaching people, they're not going to care. Yes, they're going to see that. And yes, there may be a scenario where they get upset or something along those lines, but it's very, very, very rare. They're motivated. They want to sell their property. They want to get out. So, yeah, you definitely have pros and cons with assignments.
Well,
we love doing both, obviously, but we kind of opt more for doing the assignment if, A, it's less than $5K because it's not a huge deal. People aren't going to get pissed at, about having to pay that, finder's fee, for example. Or if we have a relationship with the buyer who doesn't care that we're making 10, 20 grand on the deal, as long as it's a sweet enough deal that they can walk away with 30, 40, 50 grand themselves.
Repeat buyers sometimes too will say, hey, we're going to make this on it. Is that okay? We'll just assign it.
Yeah.
I mean, again.
And really, though, if it's a killer deal, like the scenario that we described to you all, and we say, hey, do you have a problem with us assigning this to you? We're going to make 20. And they say, yeah, we do. Well, that's fine. That's a killer deal. I'll go sell it to somebody else and make 20 or even 25 on that deal. So, it just depends also on the numbers of the deal and how good of a deal you have and how good of a deal you're selling.
Absolutely.
So a lot of factors that go into play. So those are the difference between double close and assignment.
Yeah, so next, let's talk about another option.
So again, we're talking about exit strategies here, guys.
Yeah.
Ways to exit the deal.
So another option then, so let's talk about this deal a little bit more. So, and Dave, you can be on my team now.
Okay.
So we're buying this $100,000.
I like being on your team.
We're buying this Thanks, man. I like you on the team.
Yeah.
We're buying this $100,000 house, right?
Okay.
And we know it's worth $200,000. It only needs $30,000 in work.
Yep.
What's another option? We could wholesale that property.
Yeah.
So again, this one, well, potentially. So what we call a wholesale is just carpet and paint, and that's kind of let's just assume that's what this one needs. Needs some new flooring, needs maybe some sprucing up in the kitchen, real minor stuff. New appliances are really going to go a long way, something along those lines. So we buy it for $100,000, we spend $15,000, and then we slap it on the MLS. So again, we're able to sell it to an end buyer instead of selling it to an investor buyer. So they're going to come in, and maybe we're not going to get that $200,000 because we didn't do the full updates, we didn't do granite countertops, something along that. But maybe we can sell it for about $180,000, right? So we can sell it for closer to that full market value. We're going to put $115,000 into it, but that's going to leave us a much bigger profit margin, closer to, after everything's said and done, about $50,000, $60,000.
Right. Wholetailing is definitely a great way to exit a deal. In order to wholesale a deal, you have to take control of the deal, though. That's one of the downsides to wholetailing. You either have to have the cash, you have to have a bank loan or have the ability to get a bank loan, I should say.
You've got to have money. You've got to have the
funds. You've got to have
a
private fund. You have to have somebody that's willing to give you the money if you don't have it to close on that deal, as well as have a little bit more money to fix that property up a little bit.
I guess we should call it access to capital.
Access to capital. That's exactly what it is.
You do, though. You have to have the money available to spend to satisfy the seller. Mm-hmm. They want their $100,000 next Friday, like we said.
Right.
So they've got to get paid, and then you've got to have some money to put into it and wait. You got to put it on the MLS and then wait to get paid because the retail consumer, that buying process is a much longer period than a cash close with an investor.
Right.
So again,
wholetailing is a great strategy. We talked about it quite a bit in the last episode, actually. But it's essentially rehabbing a property, but it's just very lightly. Paint, carpet, landscaping, maybe a couple other minor things. You don't have to spend a ton of cash on a wholesale deal. Like sometimes we'll essentially buy a property and not put any money into it. We maybe spend a couple $100 hiring some maids to go clean it, and then we'll throw a for sale sign in the yard and list it on the MLS. So You can also do wholesale deals where you have to still purchase the property, but you're not spending a ton of money rehabbing it.
Right. So I think the way that we like to define it, at least around here, because again, it's one of those things like, oh, what's a wholesale, what's a rehab? One of the ways that we like to define it, if you don't have to be a general contractor or have a general contractor on the deal, it makes sense. So if you can go in and manage the project with a few phone calls.
I love that.
Call a crew, hey guys, we need you to drop a dumpster off and I need you guys to go clean the trash
Clean it out, and then you call a maid.
Exactly. Then you
call
go to Lowe's or whatever and get your carpet guys out there to have it installed, or whoever you're using for flooring.
Right.
And you, again, just a few phone calls. Then you call a painting company and have them do the paint. And then it's able to list.
But you're not having to micromanage these people and go over there and make sure that you have all these permits, because you don't need permits for cleaning a house out and painting it and putting carpet in. It's just simple. You can do that whole project in maybe 1 week, 2 weeks.
Yeah, a couple weeks tops. Yeah. So it's
very,
real quick.
Very simple.
Yeah,
and actually, I do want to mention this really quickly, Mike. I'm not trying to get off on a tangent by any means, but there are ways to wholesale deals without purchasing them. You can actually list properties owner by contract on the MLS. The only catch is you have to have the permission of the seller to do so. So I could go out, let's say there's a super motivated seller, he's an out of town, guy, he comes in town to meet me, and he says, Dave, he calls me up, I go out and meet him, and he says, Dave, I want to sell this property, I want to be done with it, this is what I'm looking to sell it for, if you pay me this, we have a deal. And let's just say that he's asking a really reasonable number, and it's a good deal in my eyes. I'll say, great, no problem. And then I'll get a contract signed with them, and then I say, hey, I'm going to buy this property regardless of what happens. Here's my proof of funds. We'll close any day that you want. Now I'm going to turn around and I'm going to sell this property after I buy it. Like, that's what I do. I'm very transparent about it. I'm going to either rehab it or I'm going to sell it to a landlord that's going to rent it. However, in the meantime, do you mind if I start marketing this property? Again, if I don't find a buyer between now and close date, I'm going to buy it. Don't worry about that. But if I can get your permission to start marketing this property now, does that matter to you? Do you care? And again, if he's motivated, I'm willing to pay him what he's willing to sell it for. He's not going to care. So I'll just write in my contract, I have permission to list this property owner via contract and have him sign an initial next to it. And then boom, I can head back to the office, throw that property on the MLS, put a lockbox on it if it's vacant. Otherwise, I'll have to just wait until I can have showing periods. And I can actually wholesale that deal and have full control of that deal without one penny out of my pocket. So there are ways to do that. You have to be a little bit more creative, and you got to be a lot more transparent.
Yeah,
so
that's a
just
great
want to touch
point.
on that real quick.
Because I guess originally our first definition of wholesale was buying off market and then selling retail.
And that's not completely true.
Yeah.
There are ways to do it without buying, without purchasing, but you still have to control the deal, and that's the main point. So
cool.
What else we got, Mike? Exit strategies, JVs.
Yeah, so let's talk about joint ventures.
I love
joint
ventures.
So again, we've got a property tied up. It's kind of like, oh no, I've got a property under contract. What do I do next?
Oh no!
We're trying to sell it. How do you get out? Well, you can joint venture with somebody. So go to another wholesaler who's selling a ton of deals and say, listen, I got this property under contract. Do you have anybody who'd be interested in it? Would you be interested in it?
If you are new to this business, guys, and you do not have a buyer's list or a very small buyer's list, here is the two best ways to do a joint venture without a buyer's list. One, go to RIAs. Find guys that are wholesaling properties. Find investors that are rehabbing or buying rentals. Those are your buyers, okay? So go to RIAs. You can find these on meetup.com or RIA.com. Those people that are going to those places are investors. There's no better place to find investors other than going to a real estate investing meetup group, guys, period, okay? If you don't have RIAs in your town, or you've been there and you haven't had luck with it, go to Google, type in sell my house fast, and you're gonna see 50 websites that pop up. The people that are paying Google, AKA AdWords, they're probably spending between $10 and $50 a click to get you on their website. Those people are wholesaling. They are buying. They are rehabbing. They are acquiring rentals. Those people have capital or have access to capital, call them up. Say, hey, I'm Dave. Hey, I'm Mike. I got a deal, but I don't have a buyer's list. Are you interested in helping me sell this deal and or even buying this deal and partnering with me? Essentially, joint venture, JV is what we call that. Those people will either help you sell that deal and cut you in, and that cut, that 30, 50, 70%, whatever it might be, is something that you're going to have to negotiate with them. But they also may just come to you and say, hey, you know, I'll pay you $52,000 for this property, and if you're into it for $42,000, that's $10,000. Boom. So joint venturing is simple, guys. Don't overcomplicate it. There's probably 50 different ways to do joint ventures, but the two that I just mentioned are the easiest ways that anybody can do, very simply.
Very good. And so I'm going to one interjection, just as somebody who's paid for a lot of Google AdWords.
Sure.
You too.
Yeah.
If you're doing that, figure out the name of the company who's advertising. Don't click on their ad though. Save them $10 or $50.
Yeah, and just go down the list.
Exactly, and
right.
then look them up and call them or whatever.
Yeah.
Don't
and even tell them that. They'll be happy with you when you do that, because AdWords is expensive.
It does. It adds up. And
I think we were paying $25 a click at one point.
Yeah, it gets real expensive.
It's super expensive. But, you know, those people, think about it though. If you're willing to spend $25 to get somebody to your website, you're really, you know, their eyeballs are important to you. They're valuable to you. You're willing to spend $25 to get their eyeballs on your site. Now, hopefully, they call you or they email you. But if they go to the website and then they just leave the website, that's $25 sunk. Mm-hmm. So you got to think, people that are spending that kind of money to locate deals, they're buying deals, or they're interested in helping other people wholesale those deals.
Yeah, I was going to say it's probably not 100%, but I'd say probably 9 out of 10 of them that you call are going to be happy to take a look at the property.
Absolutely.
And try to help you sell the deal or buy the deal from you.
Absolutely.
I mean, it doesn't make sense for them not to.
Moving on.
Yep.
Exit strategies, guys. Lease options. Lease options are awesome. Mike, we just did an amazing lease option.
We did.
Tell us that real quick. Just give us maybe a 1 or 2 minute example of the lease option that we just did.
Sure. So
amazing deal.
This is a relatively low income area here in St. Louis.
Mm-hmm. Not a war zone by any means, not a bad area, but a low income blue collar area.
Yeah, it's not a great one. So the seller was super motivated. We had planned to wholesale this property.
We did.
So we tried to wholesale it for a decent profit, and I guess we never ended up finding a buyer. The reason being it was occupied, so it was a little bit more difficult to show.
It's harder to show whenever you have somebody living in the property. Oftentimes they don't want you to put a lockbox on the property because they're afraid people are going to be coming and going while they're not there, and their things get stolen. I mean, it makes sense. So you have to kind of coordinate with the lease, the leasee, the tenant,
mm-hmm.
As well as yourself and your interested buyer, and oftentimes that can be difficult.
Yeah, and again, in our company, we got so many moving parts that it just makes it even more complicated sometimes, and it just slips through the cracks, and we just didn't get this one done.
Right.
But we're kind of happy it didn't.
Oh, I'm ecstatic we didn't.
So here's what we did. We bought the property for. With all of our marketing fees and paying out joint venture partners, we bought the property for $7,500. Now this is probably a property worth $25,000 to $40,000. Mm-hmm. Well, maybe a little more, probably $40,000 to $50,000.
Probably $40,000 to $50,000.
When it's fixed up, it's
nice.
nice.
When it's fixed up, it's nice. But somebody's living in there, so it's going to be very difficult for us to fix it up when they're living in there. Nor do we want to fix it up.
Right, and this tenant has been there for a couple years now.
According
to the landlord,
with all the
$7,500. Let's call it $7,500.
Okay.
So then what we did is we said,
that's a killer deal right there, guys. I mean, we got a property has an ARV of $40,000 to $50,000
mm-hmm.
for $7,500.
Right.
Okay.
We're happy. Again, it's not a bad deal. We're happy to be into it.
How did we find that
for
deal?
$7,500?
Was it a male?
No, it was joint venture. So this was the girls.
Okay.
Mm-hmm.
Okay.
Yeah,
Perfect.
so we had to pay them out on it.
Right.
Anyways, so we're in it for $7,500. This is a property it's renting currently for $600 a month. And in my personal experience, when the rents go below a certain point, it's usually a little bit higher maintenance tenant. Usually a little bit.
If they're paying less than $500 to $600 a month, guys, you're gonna have a lot more problems.
I would almost raise my threshold to under $800. I just don't want to deal with the tenants at that level. It just changes.
It
I feel
changes,
like. And again, everybody's got different experience levels
right,
with it.
Right.
So this tenant, again, low rent. So we don't necessarily want to have that on our portfolio as a rental, because if something goes wrong or if that tenant moves out, we're stuck, and it's probably going to cost us $5,000 or so to rehab the property for the next tenant.
Yeah, or you may have to evict them and everything else.
Exactly, and then so you think about that. That's almost a full year's worth of rent when you take out taxes, insurance, and property management.
Right.
I mean, $5,000 to flip the property, it kind of eats up all your profits. So a lot of those real low income areas with lower rents, they look great on paper because you can buy them so cheap, but they are very difficult to make profitable. So here's what we did.
Yeah.
We did a lease option, talking about our exit strategy.
Lease option. Awesome.
We talked to the tenant and we said, hey, listen, we just bought this property. Are you interested in buying it? Would you want to stop paying rent eventually? And she's like, well, sure. And we said, okay, so can you afford any money to put down on an option deposit? So basically a down payment on your property. And the tenant said, yeah, I can do that. But I don't really want my payment to go up. Is there any way you can work with me? And we said, sure. So she proposed putting $3,000 down. And we said, that would be great. What we'll do is we'll basically lease this property to you for $600 a month with the option to buy it. If you pay your rent on time for 60 payments, then the option's executed and we'll quick claim the property over to you.
Right.
So it's essentially it's a lease option that just triggers automatically when she pays her rent on time.
You worded it perfectly. It's a lease option that triggers automatically. Other times you are doing a lease with the option to buy at a certain point in time, but we just kind of structured it creatively that just says, we're going to give you the option to buy. You have to put $3,000 down and pay $600 a month. But essentially, if you make 60 payments and you're not late or too late, you make all the payments for the most part. At the 60th payment, you will own the property.
And here's how this works, though. So the payments that she's making are still rent payments. She is still sending us a rent check, or rather, we're doing it in ACH, so it automatically happens for her. She is still making that payment each month, and that is considered rent.
Right.
Until the 60th payment's made, then we credit her $600 per month times the 60 payments.
Yeah, so we're essentially selling her this property for $39,000 because she's going to put down $3,000, and 600 times 60 payments is $36,000. So $36,000 plus $3,000 is $39,000. We will be into the property for $7,500. Now we will have some additional costs.
Right. So there's taxes, there's insurance, there's here in St. Louis you got to pay the sewer bill. If that doesn't get paid, they'll come after you.
Right.
So we'll probably have another couple $1,000s in expenses over the next 60 months.
But $39,000 minus the $7,500 that we paid is $31,500. And let's just say that we have maybe $3,000 worth of expense over 5 years. We're essentially going to walk away with $29,000 in profit on a deal that we paid $7,500 for.
Yeah, it's a great deal.
Now we have to wait. We're going to be getting paid over 5 years. But it's just another way to exit a deal. Lease option, great strategy. We have some good buddies that own 150 houses almost, and every single one of them.
One of our favorite episodes, actually.
Yeah, one of our favorite episodes.
Go back to
Liquor and Lease Options with Jimmy and Bob. Great guys.
Yeah, it's fun.
They're good friends of ours at this point now. But those guys, they have a ton of properties, and every single one of them, they do lease options. And another advantage of lease options, guys, I don't want to harp on it for too long here, but another great advantage of lease options is, all the day-to-day maintenance is not your problem as a landlord, because they are a tenant buyer. So essentially that is their home, and you still have the title, but essentially you're owner financing it to them. So if the faucet quits working, or the toilet gets clogged, or something minor happens to the property, that's their property. So they are responsible to fix it.
Yeah, and again, so you're technically not owner financing. It is a little bit different.
It is different.
If you were owner financing, I know there's a whole different set of things that happen. And also, a lot of the times, like ours, in this example, we're basically just
Yeah, I mean,
crediting
it is a lease.
The full
You're
amount.
Right, absolutely.
Whereas most lease options, like if it's $1,000 monthly payment, you're going to credit them $200 a month, something like that, and they're going to purchase it at the end of that for something else. They're going to go get a loan.
Right.
So this example is a little bit different, but again, it just works on a very low income area, very low value properties.
Right. But the point is, though, is that all the day-to-day maintenance is the responsibility of the tenant buyer.
If you put it in your lease option.
If you put it in your lease option, yeah, you need to word it that way, right?
Right.
But essentially what we'll do is if the HVAC goes out or the roof starts leaking, we'll either come in and fix those, or in some scenarios, we'll come in and we'll split that cost with a tenant buyer, or maybe even we'll loan them money to make those repairs, and then they pay us that money back in additional rent payments over 6 or 8 or 12 months.
Right, because you're still the person on title, so that still is your property. You don't want it going to pot.
You don't want it going to shit.
Yeah,
exactly.
you want to maintain the property.
Right. So lease options, awesome exit strategy. We got one or two more here, Mike. What is it?
So if you're trying to wholesale a property, I got a great story. This is back when I kind of first started. I was trying to wholesale a property and got stuck with it.
It happens.
I had to close on it, and basically I wasn't able to sell it. And I thought, well, shoot, maybe I was wrong. Bought it too high. So here's an easy way to escape that: rent it out.
Rent it out.
It's not ideal.
Yeah, especially
all the time.
if you purchase it. You purchase it. You got a good deal on it, but for whatever reason, all your cash buyers, they may not think it's as of a good a deal as you did, but that's okay. It happens.
So buy it, rent it out, and what I say is instead of a fast pay, you're getting a slow pay, is kind of the way to look at it. So instead of having somebody write you a check today for $5,000, you're getting checks for, let's just say, $600 a month for 60 months. Instead of getting paid quickly, you're getting paid slowly.
Or forever, if you don't ever sell it.
True.
Just lease it out, rent it out. So
you'll get your money back. It's a way to avoid taking a loss. I hear a lot of guys say, I've never taken a loss on a property. Dave, actually, you said that to me the other day, and I was like, it happens.
Right.
But this is a great way, or it allows you to avoid that, because if your timeline on real estate is long enough, you probably can avoid taking a loss pretty much.
Right.
Just hold it.
Unless you're trying to dump a property, which happens sometimes, taking a small loss. But yeah, if your timeline, just to reiterate what Mike said, if your timeline is long enough, it is almost impossible to lose money on a deal, because you can rent it out and you can essentially pay yourself back down to zero or down below a point to where you could sell that property and make a profit. So timeline has a lot to do with rental properties and the exit of leasing or renting out a property.
Absolutely.
So, guys, just to recap, exit strategies. There's more than these, okay? But these are just the main ones that me and Mike thought.
Yeah, and we focus on.
Yeah, we focus on
trying to wholesale and then pivot a little bit.
It would make good conversation. So, if you're wholesaling, double close, assignment, obviously, those are awesome strategies. Me and Mike do those every single day in our business. Wholetailing a property. Essentially, you're buying at wholesale, you're selling at retail. You may fund it, you may not. Lots of different ways to do those. Wholetailing is a great exit strategy. And essentially, whenever you do a wholesale, you do it properly, you're going to make a lot more money than wholesaling it via double close or assignment. Joint ventures are a great way to sell the properties. Finding another wholesaler, finding just another individual that can help you sell that property if you're new to the game and don't have a bunch of cash buyers. Lease options are a great way to exit a deal. Essentially you're renting it out, but you're renting it out with the intentions of selling it to somebody down the road. So you're leasing it, but you're also giving them the option to buy. And then just leasing it or renting it, being a landlord, taking the property, getting a loan on it, paying cash for it, cleaning it up a little bit, finding a tenant, and just saying, you can rent this property from me, pay me this much a month. And essentially you're, not necessarily exiting the deal, but it's ways to, start creating income.
You're exiting that wholesale.
You're exiting
that
wholesale.
You're
exiting that wholesale. That's so true. So true.
All right, guys. Thank you so much for listening.
Yeah, thanks, guys.
We've
Great
enjoyed
episode.
it. Hopefully you guys did. If you're interested in getting started in real estate, please check out the free wholesale course at freewholesalecourse.com. And we'll go ahead and wrap it up with a quote. Dave, you want to kick off our quote, which you guys have heard before.
You guys have actually heard this every single episode. If you've listened to any of the episodes, hopefully you've listened to all of the episodes. But I just really want to reiterate this, guys. It's actually in the footer. It's in the end of the episode. But you make your money when you buy real estate. Okay, I'm going to say that again. You make your money when you buy your real estate. You get paid when you sell. But you actually are making your money when you buy. You got to buy at a discount. And if you can buy off market, it's going to be way easier to get that discount.
Yeah, Dave, that was the longest quote.
It was.
For a one-sentence quote.
I'd like to reiterate it, though, man.
Well, let's read it real powerful, though, right?
All right.
Again.
You make your money when you buy. You get paid when you sell.
Thanks, Dave. Thanks for listening, guys.
Thanks, guys.
Thanks for listening to the Discount Property Investor Podcast. If you enjoyed this episode, please like, share, and subscribe to help us reach a wider audience. We would also appreciate it if you left us a review on iTunes or Stitcher. Thanks in advance for your support. And remember, you make your money when you buy and get paid when you sell. Now let's go build some wealth.